Stocks and their valuation. Common stocks represent ownership of a company. So it shows some control over a company. Some stocks are classified stocks, such as founders' shares of stocks. For example, founders' shares can exercise more voting rights, but receives a restricted amount of dividends. Closely held companies are owned by a small number of people, mostly by a family. Stocks of these companies are limitedly traded. Publicly owned companies stocks are traded freely in the stock market every day. Intrinsic value, which represents the true value of a company's stock, cannot be directly observed in a market and must be estimated. Intrinsic value of a stock is theoretically estimated price of a stock. So we say intrinsic value here, that is theoretically estimated price of a stock. Well, we will estimate the price in this class, and market price of a stock is what we observe every day in the stock market price. How did the stock market decide the stock price? By supply and demand of stock in the stock market by a lot of buyers and sellers. A lot of buyers and sellers buy and sell based on their perceived information on the economic environment, tax and political climate, and many factors. But on the other hand, the stock's intrinsic value is theoretically estimated. Price by theory using the information from the market also, right? If intrinsic value based on theory equals the stock price we observe, then that is called market equilibrium. But actually, is intrinsic value always the same as stock price? Well, we mostly don't find that because stock markets are not always efficient. And also, information we use to estimate intrinsic value is not always perfect, right? So usually in real world, it's not always the same because again, the stock market is not always perfectly efficient, and also when we estimate the intrinsic value of a stock, we have some limited information only, right? That is why sometimes we can make money by buying and selling stocks. So common stock valuation is in our chapter. Common stock valuation means estimating intrinsic value of stock. So now we discuss different approaches of estimating a stock's intrinsic value. And finding intrinsic values of stocks will help investors in stock market, such as intrinsic value and market prices. We compare these two, right? If this is greater, intrinsic value is greater than current market price, then what? We want to buy, right? We want to buy. And then if it is less than, intrinsic value is less than market price, then this market price is overvalued, right? So intrinsic value, or we can say intrinsic, well, we can say price is the price we are willing to pay for the stock, right? Let's think about why we buy, why investors buy stocks. Investors expect cash dividends and some increase in price. Increase in price is called capital gain. Capital gain. It is called capital gain. We expect two things, right? Cash dividends from the company, and also at the same time increasing in price, right? So using the dividend, possible dividend, we can figure out some present, well, the intrinsic value. It is called discounted dividend model. This model means theory. Model means theory. Discounted dividend theory, dividend model. Well, this discounted dividend model is very basic model to figure out intrinsic value of a stock. So it computes the value of a share of stock as the present value of its expected future cash dividends. So this is the basic model of common stock valuation. Let's look at some notations here. D subscript 0 is last dividend the company paid, so it is already paid, so it's known. We know the amount. D0 is known. D1 is expected dividend per share at the end of the first year. D2 is for the same thing at the end of second year. P1 hat, well, I wrote like that because of typing. P1 hat actually is expected price. Hat is expected price. P0 is current price we observe in market. We are going to use R subscript S as required rate of return. This can be used as discounting factor, to find out present value of all future dividend payment. As head is expected rate of return. R subscript S bar actually is realized actual return. So dividend yield is well, actually D1 is what we expect, right? At the end of first year. Then P0 is what we paid actually to buy the stock. So it is dividend yield. In the future, we expect after 1 year, right? D1, and then P0 is current price of the stock. So when we buy that stock, that's what we pay now, right? So capital gain yield is P1 at the end of first year. Then current price actually we pay now divided by P0 is capital gains yield. So as investors expect, a dividend yield plus capital gains yield is called expected total return. So the present value of expected future dividends can be expressed like that. The value of stock, such as estimated price P hat, is the present value of all expected future dividends. So D1, D2, D3, D4, D5, all the way to the end. But there is no end, there is no maturity on stocks, right? No maturity. So we know it's gonna go forever, infinite. There are many numerous number of dividends, right? And then the present values of all of these future dividends can be added up, and then this is value of stock. But this is very difficult to use. This formula is very difficult to use because this infinite, right? So just try to understand the conceptually what this formula means. Just it says summation of all present values of all future dividends is the value of stock now. Now let's look at look at one example here. It is a constant growth model, or we can say golden model. It's economist's name. Constant growth stock is, well, we assume well, dividend of a stock grows at constant rate, such as every year 2%, 4% every year, like that. So that constant growth is here expressed G. This constant rate is this lowercase g is growth rate. So intrinsic value of current stock estimated, right? Head is estimated is dividend. Dividend can grow, right? 1 plus g is such as 4%. It is 0.04, for example, right? But anyway, it is a growth, right? Growth rate. This is growth rate in percentage. And then d0 times 1 plus g growth square. It goes all the way. Well, again, there is no maturity on stocks, so it goes forever, infinite. And then using, I'm not going to go to a mathematical process, but using mathematical process, where you are going to use infinite geometric sequence formula, and then we get this formula here, okay, and then this one. We are going to use this as a formula to find out intrinsic value of a stock. In other words, well, estimated price of a stock now, right? So we can say, you can just say P0 hat, estimated stock price now, estimated stock price now, right? Equals D1 over required rate of return R subscript S minus G right here. Remember that if this we are trying to find intrinsic value of current stock, intrinsic value of the stock now, that's P subscript 0, and then it's going to use the estimated dividend after 1 year. Okay, so if you want to find out P1 hat using the same formula, you are going to use what? D2. Okay, D2 over S minus G. Okay, so you can, just like that, you can say P2 hat equals D3 over RS minus G. Okay. So, for example, price of a constant growth stock using Gordon rule, Gordon model. Let's say D1 is estimated dividend because we don't know yet, right? And it is estimated to be $2. Our required rate of return, RS, is 12%, and growth rate is 0.07. Actually, in real world, this is estimated, but well, in our class, let's say it is given. Then then what here? P0 hat is D1 over RS minus G, and then D1 is given, so it is $2 over RS is 0.12 minus G is 0.07 equals 2 over, well, what is that, 0.05, right, equals $40. This is amount of money we are willing to pay to buy this stock. So if market price is greater than $40, we are not going to buy. If market price, observed market price is lower than $40, such as it says $35, then what? It is $35 is lower than intrinsic value 40. So $35 means the market is what? Under valued that stock, so we want to buy. So here, let's say we know expected rate of return equals expected dividend yield plus expected growth rate or capital gains yield rate. Capital gains yield rate or growth rate is 0.07 in this case, in this example. Then our required rate of return or expected rate of return is 12%, so 0.12 here. Then what is expected dividend yield? 0.5, is it? So we can figure out the number using that model, using that formula. Now, what is zero growth stock? We expect growth rate of dividend is 0. In our Gordon model, we know P0 hat equals D1 over S minus G here. Here, G is 0. That's what it says. That's why it says 0 or growth stock. Then it becomes, if G equals 0, we know D1 over RS, right? Because D1 equals D0 equals D2, right? Because the growth rate is 0. Well, the growth rate is 0 means dividend is constant, such as $2 every year, such as, then we can just use any D. We can use D0 or D0 or D1 or D2 because they are the same, okay? They are all the same. So zero growth stock case, price can be estimated like that. Now let's look at supernormal. Supernormal, that means greater than, growth rate is greater than normal case. What does this normal mean? This normal growth means, well, stock price or dividend. Dividend grows at the rate of GDP growth, where whole economy grows at 4%, then dividend grows at 4% also, then that is called normal growth. Greater than normal growth is called supernormal. Here, vertical line is dividend. Horizontal line is years as time passes. Let's start with $1 here. Every year it pays $1. Year 1 is $1, year 2 is $1, year 3 $1, 4, 5 $1, and growth rate is zero growth rate. And then every year it grows at 4%, like this. It is normal growth. It grows like as the whole economy. And then here, this stock shows it grows at such as 10% like this for 3 years, and then goes down to 4%, such as at 4%. So from this point to that point, it is supernormal growth. From this point to the next, it is normal growth. Now let's look at how supernormal growth stock can be estimated. The price of supernormal growth stock can be estimated. The value of non-constant growth stock. Well, supernormal and then go back to normal, that's non-constant, right? Let's try to find the value of non-constant growth stock. Well, here from 0 to 1, it grows 10%, 10%, 10%, and then go back to normal 4%, right? Well, the present value of all future dividend is our basic tool to figure out to estimate the price of that stock, right? So here D1 is 1.1. Here, well, dividend is $1 here, okay? And then it grows to $1.1 because the growth rate is 10%. Here, D2 is again 10% growth from 1.1, that's 1.21. And it grows again 10% to $1.331, right? And then go back to 4% growth. So we can discount this $1.1 using 9%. Let's say 9% is discount rate here. You can use a table, present value of one single amount, 1.1, and or you can just compute 1.1 divided by 1 plus 0.009, right? And then you can get $1.0092. This is discounted like that also, 1.21 over 1 plus 0.09 squared, and then you get 1.0184, and this is discounted. Well, after that point, the growth rate is lower than 10%, to a normal rate of 4%, right? So D3 should be discounted again also. But here, because growth rate becomes normal from 10 to 4%, and we know it's going to be normal again. At 5, that's 4%, and again year 6 also 4%, right? It goes on and on. And at this point, for these dividends, we can find out the price P3 here. P3 should be the present values of all future dividends from this point, right? That means D4, D5, D6, all the way. All of these present values, well, we sum up, we add up all of these present values, and then that's going to be P3 hat. So P3 hat can be, well, we know we use the present value of dividend method here. So P3 hat can be found how? Using D4. Remember that? And then RS minus G. That means here D4 is 1.3842 over RS 0.09 minus growth rate is, what is that here, 4%, 0.04. Okay, and then that gives you P3 here. Okay, and then P3 plus this dividend, because that must be discounted to find out to become well, present value, and then you add this and this number, and then it's going to be $29.0158, and you discount that by dividing by what? 1 plus 0.09 cube, right? And that gives you $22.4055, and add all of these present values up, then it is $24.43.31. Okay, and then that's going to be estimated current price of that stock. That means theoretical stock. Theoretical stock price. Present value method of future dividends heavily based on possible dividends, right? P0 has again the 1 over RS minus G, like that. What if dividends not expected? And then what? We don't have D1 here, so we cannot estimate the price, current price of the stock. The alternative method is corporate valuation model. Corporate valuation model using present value of expected future cash flow. So future cash flow of year 1, future cash flow of year 2, well, all the way into the future, and discounted by WACC. This is, well, we're going to discuss this later. This is weighted average cost of capital. Well, in short, it's the interest rate. Average interest rate when the company borrow or raise fund. So, well, just understand this is alternative valuation model here. Well, we discussed before stock market equilibrium. if our expected return is the same as required rate of return, that's stock market equilibrium, and then our estimated stock price is the same as market price we observe. Let's look at what is preferred stock. It is kind of a hybrid. Well, actually, this is not officially named like hybrid, but it is kind of hybrid. Well, this is what I'm saying here to help you understand what's preferred stock. This is a hybrid, kind of hybrid of a common stock and bond. It has a preferred stock has par value, fixed percent of return. So preferred stock is promising a certain percent of return. So every year 2% of face value of $100, such as par value. If par value is $100, the face value is $100, such as 5% is fixed rate of return. And then every year the company should pay $100 times 0.05, $5 per share. That is preferred stock. So because it is promising a certain fixed amount of return, it looks like bond, right? It looks like bond. Bond has face value and promising a certain interest payment, right? But this preferred stock does not have maturity, so it looks like common stock. It looks like stock. In real world, companies issue preferred stocks to raise a fund, such as for working capital, and then if the company has some amount of extra money, then they buy preferred stock back, and then it looks like kind of debt, but usually companies don't account preferred stocks as debt, but sound like that. The valuation of preferred stock is this: value of preferred stock equals dividend promised, right? Preferred stock dividend divided by required rate of return.